If you're getting a mortgage in 2021 or already have a mortgage, you're going to want to watch this video to the end. Hey everyone, Conrad Neufeld here, a nationally award-winning mortgage broker, and today we're going to be talking about the age-old debate, fixed versus variable. You might be saying to yourself, there's already a lot of content out there answering this question, and most of them conclude that a variable rate is the way to go. But I want to challenge that logic, because I think this time, it's different. Now, to be clear, there is no one-size-fits-all when it comes to mortgages, and mortgages should be built with your individual goals and financial needs in mind. But that being said, there are some overarching concepts for us to fully understand why, in most cases, one might be better than the other. So the first thing that we need to understand is, what is a variable rate mortgage? Believe it or not, there are some common misconceptions that are held in Canada. For instance, a lot of people think that a variable rate mortgage's payment changes as the interest rate changes. But that's actually something called an adjustable rate mortgage, an ARM, not a variable rate mortgage. A variable rate interest rate is often determined by discounting off of a bank's prime rate. And that bank's prime rate is closely tied to the Bank of Canada's rate. So as the Bank of Canada's interest rate either rises or falls, so too does your interest rate on the mortgage. But your payment remains the same for the remainder of your term. So as interest rates climb, the percentage of your payment that goes towards interest also climbs. If the interest climbs so high that your payment no longer covers the full interest portion of the mortgage, then and only then will your mortgage payment change. Until then, your mortgage payment remains the same. So why would someone want a variable rate mortgage and put themselves at risk of a changing rate? Well, the conventional wisdom says that right out of the gates, you're going to start paying a lower interest rate. And as of right now, that's not true. In fact, with most lenders, you can get a 5-year fixed currently lower than most variable rate mortgages. So advocates of variable rate mortgages will point to these short-term savings as a reason why variable rate mortgages are a good thing. But there is a lot more to consider in the overall picture of fixed versus variable. Advocates of variable rate mortgages will also commonly say something like, well, over the last 40 years, variable rate mortgages have outperformed fixed rates. That's a terrible accent. I'm not even quite sure what accent that was. While that statement is true, that variable rate mortgages truly have outperformed fixed rate mortgages for the last 40 years, you have to take history in context. There is a reason why they can't say that variable rate mortgages have outperformed fixed rate mortgages for the last 50 years, because different economic environments determine whether one is better than the other. Let's take a quick walk through history. In 1971, Richard Nixon took the American dollar off the gold standard, making the American dollar a full fiat currency. And by 72, 73, and 74, they had already printed more money than the history of the United States combined. And then inflationary pressure meant that by 1979, Paul Volcker, the chair of the Federal Reserve at the time, had to declare war on inflation. And that's when interest rates skyrocketed to well over 20%, a historical high. And when you're on a historical high, there's really only one way to go. And so in the 1980s, with recessionary pressures and Reaganomics, interest rates started to drop. And by the 1990s, when you had the tech bubble pop, interest rates once again dropped to try to stimulate the economy, which set into motion one of the largest housing bubbles in the history of the world, which came to a screeching halt in 2008. So once again, to save themselves from the Great Recession, they printed more money and they dropped interest rates yet again. And just when the economy was getting back on its feet, a global pandemic hit. And they dropped interest rates yet again, coupled with the most amount of money printing in a single year ever in the history of this country. So in the 1980s, when you were at the highest interest rate the world had ever seen, of course it made sense to take a variable rate. You had nothing to gain by locking in a high rate and everything to gain by writing down the interest rate as it dropped. So if you flipped it on its head and you realize that Canada is currently at the lowest interest rate it has ever seen, it really only has one way to go. And then when you start factoring in the inflationary pressures of the money printing that has been done in this year, interest rates are set to rise, and rise in a big way over the next 10 years. The lesson here is that variable rate mortgages have outperformed fixed rate mortgages for the last 40 years. But these next 10 years are not like the last 40. Now, I'm not saying interest rates are going to be 20% in 10 years. They're probably going to be somewhere in the neighborhood of 8 to 12%. But the point of this is to understand that interest rates only have one way to go. But let's put our crystal balls away for a second and talk about some of the other conventional wisdom that suggests that a variable rate mortgage would typically be better than a fixed rate mortgage. One of those reasons is that variable rate mortgages often offer a convertibility clause, allowing you to at any point convert your variable rate mortgage into a fixed rate mortgage. But there's two problems with that in the economic environment that we're about to go through. The first is that the interest rates that you're offered on those fixed rate mortgage products are often at a premium to what's currently available on the market, meaning that you often get an interest rate that isn't as competitive as what else is out there. The second is that the interest rates on those fixed rate mortgages are likely to climb first before the changes happen on the variable rate mortgages. So those two factors combined, that you're not offered a competitive fixed interest rate and that fixed interest rates will move first, means that the following scenario will likely play out for variable rate holders sometime in the future. Fixed rate mortgages will start to climb, and variable rate holders will look at their mortgage rate and they'll say, well, the fixed rate is much higher than the variable rate that I have right now. It doesn't really make sense to lock it in. And then variable rate mortgages will rise. And then fixed rate mortgages will continue to rise. And then variable rate holders will say, dang, I should have locked it in. But the fixed rate mortgage interest rate that's out there right now isn't comparable to the interest rate that I have now, so I might as well keep what I have. And then the variable rates will rise. Then the fixed rates will rise, and on and on and on. There will never be an ideal time for these variable rate mortgage holders to lock in their fixed rates because they will always feel that their current rate is a substantial discount from the fixed rates that they're currently seeing. An additional reason why someone might choose a variable rate mortgage over a fixed rate mortgage is the penalties. And this is actually a valid reason. Variable rate mortgages often have a 3 months interest only penalty, making them very cost effective if you're looking to break the mortgage for any reason, including the sale of your house or a refinance. Fixed rate mortgages, on the other hand, have two common penalties, and sometimes they add a third. But the two common penalties are the 3 months interest or the interest rate differential, and then the three magic words that make the banks the most money ever, whichever is greatest. So understanding how that IRD, that interest rate differential, is calculated is a very important thing. But here again is where 2021 is a little bit different. Let's say you were a bank and you were giving out competitive interest rates of 5%. But over time, the interest rates started to drop and eventually they became 3%. Now you have a client who comes to pay off that loan and wants to give you your money back. But you have interest that you would have been able to gain throughout the life of that contract. Well, now when you take that money back, you can't loan it right back out at 5% to continue to make the same amount of money that you would have before. No, you could only lend it out at 3%. So now you're at a loss from what you currently had agreed to. That difference in income, that difference in the interest that you would have charged, that is the penalty that you charge your existing client so that you're not out that money. But now let's say the reverse happens. You gave out the interest rate of 5%, but instead of interest rates going down, over time interest rates actually went up. Well, now you actually have an incentive for that client to pay their loan back. Because if that client pays off the loan, not only can you charge them a 3 months interest penalty, but you can actually take that exact same amount of money and you can loan it back out into the market for 7%. You're now ahead. So as interest rates fall, penalties increase. As interest rates go up, penalties go down. There is one caveat here. Big banks in particular have a very aggressive way of calculating their interest rate differential. So even though interest rates might rise and they have something to gain by you paying it off, they still may charge you a significant penalty. So if you do take this advice and you do decide to lock in that interest rate, please do it at a non-bank lender and have an unbiased mortgage professional review your mortgage. If you've made it this far, thanks so much for listening. Please consider subscribing, hitting the bell notification so you're alerted when new videos come out, liking and sharing this one.